How's it going, everyone? My name is Alex from the Aussie Financial Journal, and today I wanted to talk to you guys about growth investing. Now, it's an age-old debate between dividends and growths as to which is the more preferable option. In my view, it can be either way. It just really depends on sort of your strategy and your personal goals. With that in mind, today I want to talk about growth stocks, and I've had a look and come up with 3 fantastic ideas that could be a purchase in January. So firstly, let's talk about what growth stocks are. Now, essentially, growth stocks, as opposed to dividend stocks, are ones which grow in share price and are more focused on building up the company value and giving returns to shareholders through the appreciation in their share price. This is obviously different from dividend stocks where different companies pay regular payments in the form of dividends. So what exactly does a good growth company look like? Well, I've picked 3 companies in this video that I believe possess excellent growth opportunities. So the first company I'm going to talk about today is Afterpay. Now, Afterpay is obviously a leading player in the buy now and pay later market space. Now, since the company was first released to the public in 2017, the share price has actually appreciated by a whopping 876%. This means that if you invested in this company when it was first released, an initial, say, $2,000 deposit would now be worth something in the vicinity of $18,000, which is quite impressive. And this just sort of demonstrates how good a growth company can potentially be if you can pick a winner. Now, the huge amount of growth that this particular company has seen is largely driven by the huge uptake in the younger demographics of the buy now and pay later services. What we've seen is younger people typically avoiding credit cards and have instead chosen to go with companies such as Afterpay or maybe a Zipco. And on the internal side of things, Afterpay itself has a great managing system with great people and has also seen a good amount of growth in the US market recently, which means it's very focused on growing its international presence. On the flip side, however, and these are sort of the type of things that you'd have to consider if you're considering buying a particular company. What we've seen is that there's quite high valuations on the share price at this point, which means that it might not be the best opportunity to buy at this point. Some people believe that the actual value or the share price as it is now is more of a future indication, which means it's sort of priced in all the high confidence it has going around at this time, which might mean that its share price is inflated and it's not actually reflective of the true value of the company. With that being said though, the current share price is at $23.10. And if you look at more of the intrinsic value of the company itself, you may see an argument to say that this is actually fair valued or potentially undervalued, which means that there is an opportunity there for growth if you believe that the buy now and pay later sector has room for improvement and has room for growth in the future. So the next company I want to talk about is CSL Limited. Now, this company is a classic blue chip on the ASX. It is quite big with a huge market capitalization, and it has some of the strongest company fundamentals that we've seen in a while. Essentially, CSL is a marketer and distributor and actually a manufacturer of pharmaceutical and diagnostic products. It has seen some really good growth in the past couple of years, with the most recent having some excellent numbers. For example, they've booked a 11% revenue increase, and they've also booked something like a 17% profit increase, which means that the company is headed in the right direction. In addition to these great numbers, what we're actually seeing as part of the products of the company is there's currently a shortage going on in the sale and distribution of immunoglobulins, which basically means that since they're one of the leading providers in this product, they've actually raised their prices and are seeing an increased amount of revenue coming from that distribution. And this basically means that they have sort of a very good market presence in a number of diagnostic and pharmaceutical products, obviously, meaning that they can take full advantage when there's issues like this that arise. However, on the flip side, the company faces the same sort of issues as Afterpay. It has a very inflated share price, which at the moment is currently trading at 49 times its price to earnings. This number 49 is essentially a ratio which describes just how cheap or how overpriced a company is in relation to its earnings. So a value of 49 is very high, meaning that for the potential growth that you may experience it might be a little bit overpriced, and for that reason, this one might be a little bit less of a good purchase at this point in time. And currently the price is trading at about $300.10. So the final company I want to talk to you guys today about is A2 Milk. Now essentially A2 Milk has been one of the biggest growth companies we've seen in the past 5 years on the ASX. And like CSL, the reason for this is it has such great fundamentals within the company. It has such an excellent product that people would be willing to pay high amounts of money for. It's got such a good and strong brand name. People all over the world know of it. And for that reason, I think it's got one of the best potentials to grow in the future and to give you such great returns for shareholders. So A2 Milk is one of the leading providers of milk and infant formula products. It essentially has made such a strong brand name for itself in this space. What we see is people actively searching for this company and for its product. So if you're in any given place at any given time and there may be options available to you, you may just go with A2 Milk because of how reliable a brand name it is and because of how good the product is itself. It's sort of similar in the same way that a Pepsi is with a Coca-Cola. You might go for the Coca-Cola because it's tried and tested. Despite the fact that Pepsi is very similar, you may just go with the name and the brand that you know. So that's why they've got such a good growth potential. On a more micro scale, what we've seen is the actual numbers of this company perform substantially well over the past 5 years. And in saying that, the actual company itself is forecasted to grow and to perform even better in the future. There's a US presence which is forecasted to grow. There's an Australian fresh milk sale and distribution that's expected to grow. And for these reasons, what I would say and what I suggest is this company demonstrates all the good qualities of a growth stock which you would probably want to be a shareholder in. It's currently trading at about 14 cents, which means the valuation itself is quite high, as you would expect from all these companies, given that we're in a bull market and the stock market is seeing all-time highs. So the actual company itself is valued quite high, but that's the same for a lot of the other companies. But because of the forecasted growth that we've seen, because of the tremendous performance of the past, I would suggest that this is a very reasonable buy for January and would see very good returns for you if you held it for long enough. So there you have it. Those are the 3 companies that I've looked into recently as possessing excellent growth opportunity and being excellent for a growth portfolio. Thank you for watching for today. Be sure to leave a like and subscribe and let me know how you're coming along in your financial journey.